The ETF market is exploding right now, up 15% in just asset growth alone over the last 2 years. You see ETFs that are going over the $10 trillion mark worldwide. We have over 10,000 ETFs that are actually tradable these days, which is something that was unheard of just years ago. And we have the expert among experts with us today on Buy, Hold, Sell. Welcome, everyone. I am your trader, Todd Schoenberger, and I am joined by my friend and co-host, Tobin Smith, out in sunny and hot Scottsdale, Arizona. Toby, basketball season right now.
It's not hot, okay?
It's hot, and the Arizona Wildcats, right? I figured we could talk about it.
I was going to say, Arizona Wildcats are hot. And again, just for our guest, Todd is not going to have a heart attack. It sounds like it, but he's not going to.
There you go. Well, with us today, we have Aniket Ullal. He is the head of ETF Data and Analytics over at CFRA Research. Aniket, welcome to Buy, Hold, Sell.
Thank you so much, Todd. Excited to be here. Good to be on, Toby.
Cheers.
Absolutely. Well, we know that you are the expert in this ETF space. Everybody's talking about ETFs these days. You have a lot of the business networks, they have shows devoted to ETFs. And I know they go to you because as the single source of expertise in this industry, in this market. But let's start talking about ETFs because the growth rate alone is big. We were talking right before the show, talking about how it looks in the US, but also globally. Can you give the audience some numbers, though? Can you tell everyone what the expectations may be for the ETF market in 2024?
Absolutely, Todd. I share your excitement for the ETF space. Just to give you an idea of how long I've been in this space, when I started working on ETFs, there were less than $1 trillion in ETF assets in the US. There were less than 1,000 ETFs in the US. Today in the US, we have almost reaching 4,000 ETFs now. We have over $8 trillion in assets in the US. Globally, that's over 11 trillion, getting close to 12 trillion. And as you said, over 10,000 ETFs listed. That's not including cross listings. If you include cross listings and multiple share classes, we have almost 20,000 listings globally. So this is a space that's been growing tremendously. It's opened up a lot of asset classes, a lot of themes, a lot of factors and strategies to investors. So I'm excited to be here to talk about it.
Yeah, I'm intrigued by not only the growth, but the niche of a niche of a niche. A momentum, a value stock ETF, a growth value ETF. And then, of course, the explosion of the option writing ETFs. My first question to you is, I think the narrative now on the Wall Street world is that the reason why we have no VIX anymore is because they're selling $20 trillion of options every month. Where are you in this camp?
Well, firstly, just going back to your point about how the ETF industry has evolved, what's been interesting is seeing it go from an industry that had its roots in low-cost smart beta to then moving into factor and thematic categories, and eventually moving into now active and, as you said, more strategic type of exposure. Certainly, as you mentioned, covered call, options-based type strategies has certainly become very successful. JP Morgan, most notably with their JEPI ETF.
They're the godfather of the whole thing,
yeah,
but now there's
absolutely
150 of them in registration right now.
That's right. I think given the success of JEPI, and then they did one on the NASDAQ as well, all of that's resulted in not many other players coming in, but it's really, that's really created a new category. I'd put along with that, it's kind of cousin, which is again options-based, which is defined outcome ETFs. So these are ETFs that kind of where investors can essentially cap their downside by sacrificing some upside exposure. And that's another category which I think is really investors will find really interesting. Innovator Management was the first provider in this space. Since then, we've seen First Trust and other ETF issuers come in. So I think that we're slowly seeing the ETF vehicle move from just low-cost beta exposure, then to smart beta, and now transparent active and these kind of more strategic types of exposure.
Yeah,
so it's a very exciting time to kind of look at the industry.
Bear in mind, audience, that beta just simply means outperformance and outperformance with less volatility, right? So I get that, but tell us more about these fixed outcome. In other words, I'm essentially saying I'm not going to lose money, but but because I'm not going to lose money, I'm not going to make as much.
That's right. So, I mean, the way they're structured is essentially each one gets reset every month. So you can buy a January series and that will be set for till the next January. So it works on a calendar year cycle. And so they release one every month. Each one has a range of essentially parameters. So for example, you could say, I'm willing to give up, any returns above 9%.
Okay.
As long as I get protection for X%. And those percentages vary. And they're essentially based on flex options. So, the investor can kind of choose based on their risk return profile, what kind of products they want to go for. And so essentially you've got an entire menu. That menu will be based on the calendar month. And then also the parameters around downside protection and upside.
And this is S&P 500 and QQQs and, the largest indexes?
Yeah, so generally indexes that have kind of a liquid options kind of market around them. So yeah, most of them are S&P 500, QQQ is the other one, but now we're seeing all kinds of variations come out. But essentially, it's the big headline indices typically.
So in essence, it's January 2nd, and the market's opening for this year. And I say, you know what? I don't want the brain damage of having this thing go up and down, up and down, and up and down. I'm willing, if I can get a 12% return, I'm just pulling that out of my, and therefore they're going to be selling put options and other things to provide that. I'm happy with that. No brain damage. I mean, is that basically the selling point?
Well, yes, it's not a guaranteed return, but it's a bounded return. So essentially, So I mean, essentially, it's saying I can be within a certain range. It's particularly useful in markets where either for investors who want to protect some downside, right? I want to keep some upside, but also protect downside. So it's useful for those types of investors, and it's also useful in a market that's going sideways. I may not have a strong directional view on the market, and therefore these kind of products can be really useful. So it's an interesting innovation in the market.
Yeah, I would think after the greatest 4 months in stocks in 25 or 35 years, depending on how you do the math, that may be a pretty good, product to take right now, right?
Exactly. So, I mean, there are markets like we had in 2023 where obviously you're giving up a lot of upside, right? So it's going to be a product for certain kinds of market conditions, not for all market conditions. But certainly after a market where we've had 10 years now, of like 11, 12% annualized returns, you may think that the market's going to take a breather, even though, of course, that we say that we've been saying that for a while now. But so certainly in those kind of markets, mature bull markets, it may be a good option for investors.
And are these distributed more by RIAs, by investment advisors than actual, self-directed investors coming in and make all these decisions?
It's a combination, actually. I think there is interest the beauty of ETFs is they trade on exchanges like stocks, so anyone can buy them. The first company that actually entered this space was Innovator Management out of Chicago, and then we've had other kind of firms come in. It's bought on exchanges both by RIAs and self-directed investors, but it's another way for RIAs to add value to their clients because
if no one had ever heard of these before and they came in and they're shaking just because they're in the chair because they're sitting talking about their money. Boy, I would pull this out of the sack and they'd say, you look like you're sort of a nervous Nelly. Is that fairly accurate? Yes, it is. Okay.
Right. You are right, though, because for the RIA market, it used to be with brokers, they would look for the loaded mutual funds. And now with the advisory side of it, where you're charging an advisory fee, it just makes sense to look at the QQQs or the spiders and go from there. And it seems to be working, and you don't really have to think too hard about it. It's a nice feature.
When I started as a wholesaler to pension plan, I'd walk in and I say to myself, all right, these guys look pretty stupid. I'm going to pitch the high load one to these people, right? Because it has a better quote unquote track record.
Right.
That meant I got another 25 basis points when I sold it. All right. I mean,
right.
There was no choices. There was just no choices, and it was completely hidden behind everything. This is like the world, has completely changed, and now I can take a 10-question test to tell me what my risk tolerance really is, and then based on that, you don't need an algorithm to say go with B, not A, right?
Yeah, definitely. So Aniket, you have a couple of favorites that are out there that you really want to talk about, and the first one I saw really focused on Japan. It's the WisdomTree hedged Japan ETF. Toby's been talking about Japan for a little bit on the past few shows, and that's
Right.
Toby's an expert. He knows what's going on in
No,
the
that means
markets.
he's trying to say is that's the sign of the top for Japan. That's what he's trying to say. Okay.
So Aniket, tell the audience what's so special about this ETF.
Well, there's two things we like about this ETF. One is,
Which
as you know,
one
when
is
you
it?
invest,
You got to tell us which one it is.
this is the WisdomTree Japan Currency Hedge ETF. So the ticker is DXJ.
Okay.
And the reason I picked this is for two reasons. One is we like Japan as a market, and the second is has a currency hedged overlay, and I'll talk about each one. I mean, one of the things is that in Japan we've seen now for some time some pretty fundamental structural changes. There's much more emphasis on better corporate governance. We're finally moving out of a negative interest rate kind of regime. There's more optimism around economic growth, and the Nikkei index for the first time has now gone back. Finally reached its peak after 34 years, I think more than 30 years.
I was going to say, when you were in diapers, it was at its high, whatever it was.
Exactly. Right. So there's a fundamental long-term story here. The important thing to note is that the corporate governance story has actually been playing out for a while. It's only now that performance is actually catching up to it. So there's actually a fundamental story here in terms of what's happening, the trajectory for the country. More importantly, there's a nice currency story, because this is one of the things I like about ETFs is you can actually get fairly sophisticated strategies that may earlier have been available only to an institutional investor, but now is available to a retail investor in a fairly easy to access form. And essentially what this ETF does is that it hedges the Japanese yen to USD movement. So if I'm investing in Japan and the local market does really well, as a US investor, if the yen weakens and I convert that back into dollars, I'm actually losing a lot of the return.
Right.
What this does is it hedges that currency movement. So essentially, I'm able to access
it puts a floor on the currency. Yeah.
Exactly. So I'm able to access the local market returns and not just the USD returns. That's hugely important. I mean, if you look just this year, the local market is up 24%. The unhedged version is up 12%, which means if you invested in DXJ versus EWJ, which is the unhedged version, there's a 12% performance differential. Last year, there was the unhedged market, the unhedged version was up 20%. The hedged version was up 40%. You're talking about, again, a 20% differential between the unhedged and currency hedged version. So we like the fact that there's a long-term trajectory here for Japan, and the fact that you can access it through a currency hedge version. So it's a nice little product that we think is a pretty good for investors.
Yeah, for the people at home, understand two things. Japan cut their interest, their cost of funds rate to a negative. Now it was only done a negative. I don't want to go into explaining how that's possible, but it's been there for about 25 years, actually more than 35 years, right? So right. What happens is that, hey, I'm so excited, my Japan index fund is going up. Except when I go to sell it, if the currency's got against me, I'm losing half of what I made, right? Because if the yen goes down and the dollar goes up, the same amount of yen buys this amount of dollars, right? So exactly. That's what's so cool about what you're doing. Because for years I've advised people to stay the F away from Japan for all the obvious reasons. But the currency risk was like the final straw. Yes. Is that the dollar was going up, even if I was wrong about Japan, I'm going to be right about the outcome to you. And now you've taken that risk out. I think it's fabulous.
And Toby, to your point earlier about how ETFs evolved, I mean, this is a case where these kind of strategies were not available to investors, right? Yeah. This was something a sophisticated pension fund could do, but a regular investor buying something on an exchange couldn't do. And that's what we love about some of these products.
Yeah, that's right. And that ETF, it has almost $4.5 billion under management. It has you're looking at a 24% year-to-date return. I mean, it's annuitized at almost 100%. Can't go.
What's
can't
that
go wrong
ticker
with that,
again,
Toby.
Todd? What's that ticker again?
It is DXJ. DXJ. Okay. Delta X-ray Jenga. And we will have all this in the description as well. Okay. With links sending you there. Let's stick to the overseas tone though here of the conversation, because you also like this ETF that's focused on China. and it's the iShares, it's the emerging markets. Do I have it right? But you're taking away from China. It's just emerging markets, with the exception you're removing China out of the equation.
I was about to go like this, and then obviously Todd was wrong as usual. So that's why
I was wrong. I was wrong. So tell us, Aniket, tell us about this ETF.
So this is the iShares Emerging Markets ex-China ETF, EMXC.
What's the ticker?
It's EMXC, so Emerging Markets ex-China. EMXC, it's easy to remember.
Got it.
And the reason this is interesting is that, one of the things with investing in ETFs is the underlying index and the way it's constructed essentially determines the exposure you're getting, right? So most of the ETFs that track international indices or provide exposure to markets outside the US generally tend to track an index either from MSCI or FTSE. These are kind of the big providers out for indices outside the US. The MSCI indices in 2017, 2018 included China AB shares into their index, which means at one point, China made up 30% of all emerging markets exposure. The problem with this is that China has been terrible over many years now. And so essentially you're getting defaulted into an ETF where 1/3 of exposure is in a market that has had over the last 10 years a 1% return. And this has been a problem.
I assume the manager, after being the crap beat out of him for 4 years, saying, what the heck here? Can't I have an ETF where we're actually in emerging markets, but not in China, please? So I don't have a heart attack? Yeah.
Exactly. And the interesting thing is this ETF has taken in, I think, 5 or 6 billion this year. The same China-focused ETF from the same manager has lost $500 million. So you can already see investors now starting to rotate into this because they can see that there's other markets in China. Firstly, there are structural reasons to not be in China, so heavily weighted to China right now, right? The post-COVID reopening wasn't as strong as anticipated. As property issues, is certainly tension between the US and China. And more importantly, as companies kind of reconfigure supply chains, some of those benefits are going to other markets like India, Vietnam, and so on. And so I'd rather be in an ETF where there's a higher weight to those markets. And
hey, let's talk about Mexico. Wait a minute, let's talk about Mexico. They're quite a beneficiary from the onshoring.
Absolutely.
Before Mexico, hold it real quick on this. You said that it has inflows of 5 to 6 billion this year. That's doubling its assets in just a few months. It's incredible.
Yeah, it's been hard over the last year and a half. Over the last year, I'd say, yes.
Okay. Yeah, that's still remarkable, that type of growth. Interesting. Well, I like it. Well, listen, guys, let's leave it there on the international side, because coming up after the break, Aniket has 3 more star ETFs that he wants to get into that are focused here in the US. And we want to talk about that because clearly there's a macro backdrop to those stories as well. So with us today, we have Aniket Ullal. He is the head of ETF Data and Analytics over at CFRA Research. And he's going to be with us right back after the break. Please stay with us.
Buy, hold, sell, brought to you by CrossCheck Management.
Welcome back to Buy, Hold, Sell. Well, we're talking all about ETFs today. And why wouldn't we be? Because it is clearly the hottest Wall Street product that's out there right now, as we see inflows that are just flying into these ETF companies. We're going to talk all about the Bitcoin ETFs that are out there right now, but that's later on in the show. But we want to talk with Aniket Ullal, who is the head of ETF Data and Analytics over at CFRA Research. Aniket, you're still with us. In the first block, you were talking about some international focused ETFs. Let's start turning the page to the domestic side. You have a couple that are your favorites, 3 of them, as a matter of fact. And we really want to talk about this blue chip one that you really are recommending, and you're really getting into it. Can you tell the audience a little bit about this one, this blue chip ETF?
Yeah, after that promo, no, he doesn't know anything about it. He just wrote it down a second before he got here, Todd. I mean, come on, man.
Well, Todd, I decided to switch it up a little bit and pick an active ETF. So this is an ETF that's not tracking an index. So this is a Fidelity Blue Chip Growth ETF. The ticker is FBCG. And I picked this for a couple of reasons. One is, as you know, we've been in an interesting market, very growth dominated market, very mega cap dominated market. But that also creates challenges for investors, because we've had a situation where, I mean, as you know, NVIDIA and the Magnificent Seven have really driven a lot of returns. And so the question is, what do you do going forward? And so our view is that we think that the sectors that have been strong last year will continue to be strong. So we think staying growth-oriented sectors like technology, communication services, consumer discretionary, those will continue to be strong sectors. But at the same time, one has to think about, do you really want to be so weighted in some of these individual stocks, and how much should NVIDIA make of your portfolio? So these are some of the reasons why we like active management in this particular space, because it allows managers to kind of calibrate the exposure to particular stocks. Now, this particular fund has done well because they really doubled down on the AI themed stocks. So they really had a huge weight in NVIDIA. I think it's about 11%. They have a huge weight in Microsoft. They have a huge weight in Amazon. So these are kind of the big winners in the AI and cloud computing space. What I'd be interested to watch going forward is, as the market breadth starts to improve, and if market breadth starts to improve, will they kind of diversify and will they move into some of the other stocks? So the fact that they're actively managed and can make those decisions is one of the reasons we picked this, because obviously in an index fund, you're kind of just going to track the market, and you can't make as many decisions around what to do with some of these stocks. And in a market that's so narrow, I think having the ability to make those adjustments is important. So that's one of the reasons we picked this.
We've been, thank gosh, since March of last year, after I was at the ChatGPT conference and saw what the hell was going on. Right. I didn't think that NVIDIA was going to come out with a 3x times their earnings, in a quarter. But anyway, we got long these things. But what I've been doing with our subscribers and with investors is saying, now listen, I've seen this rodeo before. I was on the bucking bronco in 1997 to 2000, and when JDS Uniphase went from $12 to $337, when MicroStrategy went from $15 to $390.
Right.
If you did not take your money out first and then take the second amount out again and followed, if you didn't do that, and then MicroStrategy fell to $5, you're a bonehead. I used to do these like seances at the money shows, Todd, where I'd say, dude, did you own JDS Uniphase? Yes, I do. I own, what percentage of your portfolio is it? Oh, it's probably about 35, 40%. All right, stand up, sir. And I'd say, spirits of JDS Uniphase be gone. You've got to sell it. You've got to take profits. And that's, as a professional money manager, I think you should be locked up if I'm running a portfolio for someone and, we're fortunate to buy SMCI at $125. That is now up 937%. If you haven't taken 3 chunks of profit from your original out, then you're just missing the boat. On the fact is that you're not going to be able to sleep next day because so much of the percentage is there, which is then going to make you make bad decisions. That's the biggest reason I think that that people, active managers add value. Now, the fact of the matter is, traditionally, they haven't added value in 35 years versus the indexes. So there's that little thing. But every 30 years or so, they really have a chance to add value. That's what I'm trying to say.
It's generational. Aniket, is it concerning that it's there really aren't a lot of assets in this ETF. It has 1.3 billion. Is it fairly new?
Wait till you see my next one. That has even fewer assets. But the good news in the ETF space is that liquidity of the ETF itself doesn't matter that much, because with the way the create redeem process works with ETFs, investors can always go and redeem shares through APs. And so really what matters is the liquidity, the underlying. These are the biggest, most liquid names in the world. So we don't think the smaller assets is really an issue. It is a relatively new ETF. And I would say Fidelity is still kind of growing in the ETF space relative to the mutual fund space. But given that it's a very liquid underlying, we don't see that as a concern.
All right, what's the ticker again?
It's FBCG. So Fidelity Blue Chip Growth.
Yeah.
Okay.
Yeah, that's a good one. Now on to this
You don't have
next
to have
one.
a Fidelity account to buy it.
No, you can buy this through any. Yeah,
Correct.
this is
Well, a
available
lot of
through
times
any
when we
account,
say
yes.
talking about a Fidelity,
Right.
I get email and text saying, but I don't have a Fidelity account. So
Right.
Yeah.
Right.
Yeah.
just make that
No,
point.
they have selling agreements with other firms. So yeah, you definitely there's
Just
shelf
to be
space.
clear, each
everywhere.
wirehouse or brokerage firm may have their own list. So I mean, just I would add
Yeah.
that caveat. But it's available on all the exchanges, so it should be available
There
to
you
most
go.
investors. Yeah.
Okay, this next one, moving on, is going to be, I know this is going to be a Toby favorite. This is a supply chain ETF, symbol is SUPP for supper, Toby. No, supply. But Aniket, what's the story with this one on the supply chain ETF?
Well, one of the nice things about ETFs is, they're really good instruments for betting on long-term trends and themes. And just picking on Toby's point from earlier when he mentioned Mexico, one of the implications of what's happening with supply chain beyond India and Vietnam is nearshoring and what's happening within the US. And what we like about this ETF is the high conviction play on companies that may benefit from nearshoring, logistics changes, supply chain transformation in the US. It was actually launched by a mutual fund company called Engine Number One, which is kind of a startup company, got acquired by TCW. And I think now is under kind of a part of a bigger franchise. And it's a small fund, but again, if you're holding any stocks, some of the bigger stocks in the US, that again shouldn't be a concern. And there aren't actually that many pure play funds focused on nearshoring, so that's the reason I picked this. But
yeah,
again,
also remember that there's about 15 different Mexican-based companies that are in the process of IPOing, and starting with the biggest company that is a REIT. It's going to be a REIT, and it owns a warehouse space. The warehouse space is packed. You have to make a reservation for a year in advance to get warehouse. I mean, it's on fire, and Monterrey, the state of Monterrey, on fire. The state of Puebla, So, and again, on a risk basis, it's this dollar versus a peso. Guess what? Dollar wins. So, so you want to have it, hedged that the peso is going down. But now that they're actually, making money and actually are, attracting business, then now I'm saying you really don't have to hedge necessarily because the peso has gotten stronger against the dollar. So,
Toby, it only has 15 million under management. Very, very small.
Oh, now let's just take it over, Todd.
There you go. I like that. Okay, let's move on to the last one here. This Vanguard Treasury ETF. Did I get that right?
That's right, but this is intermediate treasury. Well, one of the reasons I picked this is because, I mean, as you know, we've had a lot of investors move into short-term, short duration products. I mean, we've had money market funds go up to 6 trillion, right, in the last year in assets. We've had so much money move into short-term bonds, but now it seems clear that, the Fed is still sending out somewhat dovish messages. We're going to see fewer rate cuts than we expected at the beginning of the year, so maybe 3 this year, but certainly it's going to be in the direction of cuts and not increases. And that means that investors can kind of take on a little bit more duration risk. Maybe, if you're in very short-term bonds, there's reinvestment risk that comes into the picture. And so we're kind of trying to essentially pick this as a way to kind of play, rates being cut sometime this year.
Yeah, it's a very good point, because let's remember everybody's sitting in their Schwab money market account getting 5.25%. And it's been so long since we've ever remembered that actually when interest rates go down, bonds go up in value.
Exactly.
Because, for the last 16 years, that hasn't been right. So I totally agree with you. How about mortgage REITs? Now, for instance, we're getting along some mortgage REITs because, again, as interest rates come down, they outperform bonds by 2 to 1.
Yeah, I mean, there's multiple ways to kind of play rates. I think just thinking about rates and how to factor that into a strategy, I think is really critical. I just picked one just as one kind of way to do it. But certainly, I think there's a lot of creative ways to kind of look at it. And certainly taking on credit risk is another way, like corporate bonds is another way to go, corporate bond ETFs.
Right. In other words, higher yield corporate bonds that when interest rates come down, they go up in value faster than owning a AAA corporate bond. Yeah.
And it's basically flatlined for the year, but it has over 31 billion under management into this. I guess everyone is waiting for those rate cuts to occur and then taking advantage of it.
Todd, you're all about size, okay?
Well, it's a brand name with big numbers, so somebody must know something. So I would think that's well,
the thing with this is a Vanguard fund. Vanguard is now kind of slowly challenging BlackRock as the biggest ETF issue. A lot of their funds tend to be pretty large.
Todd used to work for Vanguard, as I remember, so maybe he has a soft part in his heart. But the fact that they charge so little relative to other players is that net, it could be flat, but against the other guys, if you want to be in this space, you're going to be better off in the Vanguard, 9 out of 10 times.
Yeah, so true. And it's got a yield right now of just under 3%. And but yeah, I do agree with you. So, yeah, so we'll see how that plays out for the rest of the year. Hey, so we can't let you go, Aniket. We got to talk about the Bitcoin ETFs that hit the market recently. What do you think? I mean, are there more on the horizon? I mean, inflows are just sending Bitcoin to the moon right now. Toby's really follows this side a lot, much more closely than I ever had. So
easy for you to say, Todd.
Yeah, right. I know. So, Aniket, do you see this for the remainder of the year? Do you see more hitting the market? And what does this mean also for the other cryptos?
I think in terms of the Bitcoin itself, I really see it in two phases. I think there's an initial excitement phase when these products came out, and there was a lot of pent-up demand from people who wanted crypto exposure but couldn't access it in the right vehicle, because you had futures-based crypto ETFs, but then they've got other issues with futures-based products like roll costs and so on that eat into returns. And then you had products like GBTC, which was a trust and not an ETF, and so it was really trading at a discount to its NAV. And so you had a lot of issues with the other options. And I think there was a lot of appetite for a spot Bitcoin ETF that's regulated by the SEC. So I think the initial spurt that we've seen has exceeded everyone's expectations. But in hindsight, probably shouldn't have been such a surprise, given some of that kind of pent-up demand. I think going forward, we're going to see a bit more of a slow grind. I think the demand is still going to be there, but I think now it's going to be a slower grind to build assets. By that, what I mean is that now just managers to go out, get onto the various platforms, educate advisors about how the product works, and so on. I think the initial adopters have come in. I think there's going to be continued demand, but I think that the rest of the users are going to need more time to come on board. So that's kind of my overall take on it. In terms of other cryptocurrencies, I mean, the most natural one is Ethereum. We already have an Ethereum futures-based product. So from a legal point of view, I think it'll be difficult for the SEC to deny it, because when they denied the spot Bitcoin, when they had already approved the futures one, that's when they kind of lost in court and had to approve the spot one. So I think it's going to be difficult for them to deny the spot Ethereum, but at least for now, they've kind of kicked the can down the road and have delayed the approval. So, but I think eventually it's possible we may see a spot Ethereum product, though I'd be surprised if it's as much in demand as the Bitcoin one.
Yeah. Well, what's interesting to me is, we came in October. We had the Supreme Court basically said you're full of malarkey, and all of a sudden, there was an interest in Bitcoining again. But the theory was, or let's say the narrative was, now that we can't buy Bitcoin yet, let's buy the miners who actually benefit from this price going up. And we did stupid money with these miners. And then all of a sudden, just like on a day, somebody said, forget the miners, I'd rather own, why do I want to own the proxy when I can own the freaking Bitcoin, right? So then the miners tanked, right? Well, then I'm just looking at this chart from 2 days ago. All of a sudden, the miners take off again. And where's the narrative? Because now we already have the public one. We own the Ethereum chart because the only way to own it, in our managed account funds. And Ethereum is, in my opinion, going to get approved simply because of the already existing, precedent, right? And Ethereum actually has a much wider and broader use case. I don't want to get into all the 432,000 cryptos out there, but let's just say that I own one called Jensen Huang that my my new editor coming on for our newsletter service, the thing's only up like 25,000%, Todd. I mean, I put $100 into it. It's 25 grand. I looked at this thing today, right? So
Incredible.
we're not talking about that yet, but we're just talking about Ethereum and Bitcoin. The Bitcoin has its halving coming up here on April 14th, and that's where the miners get half of what they used to get in Bitcoin for the same amount of electricity, et cetera. So in theory, and I think this is where I'm trying to get to, in theory, people are starting to realize that there's a lot of these miners that are going to be not buying Bitcoin because their energy cost is more than what they're going to get in Bitcoin. So if you look at CleanSpark, Todd, if you look at Mara, you look at IREN, which actually is nuclear power, so it's a zero carbon footprint. Freaking CleanSpark is up 19-20% today. It was like that, and it was like this, and now I must not be on the right chat boards, Todd, because somebody is now changing the narrative to get back to saying that, hey, the miners that are the low-cost miners, we are really going to be good for this. They're not the proxy. They're just going to make a shit ton. That's a technical term of money. And so I just pointed out to the audience that and also then Coinbase, we own a thing called CONL, which is a leveraged ETF that owns just Coinbase. That was only up 22% today. If you buy the option was up 86%. So there's other ways of playing Bitcoin than just simply buying the ETF, because there are derivative plays. That's my one and only point.
Right. Yeah, we definitely need a biz talk today chat board then. So get everybody on that, and we'll have some fun with it. So Aniket, I can't thank you enough. You definitely are a rock star when it comes to these ETFs. You know your stuff, and we definitely would love to have you back sometime soon on Buy, Hold, Sell.
I would love to be back. Thank you so much for having me on. This is
and I put all these stocks in our watch list, brother. So
yeah, you got it. We will.
Anything you want to pull back? Anything you want to say? Because they're going on your record.
There you go. That's right. We're memorializing the whole thing. And all of these will be in our description. We encourage everyone to actually go and see Aniket's suggestions here and see what everything he had to say. We'll also provide links to CFRA Research, which we encourage everyone to take a look at, and we love that company. So they're awesome. So on behalf of Aniket Ullal, who is the head of ETF Data and Analytics at CFRA Research, and Tobin Smith, who is the host of the new Money Mavericks program, which is debuting this week on BTT. We're going to really promo this thing. We want to definitely welcome everyone to check it out. I am Todd Schoenberger, and we want to thank everybody for joining us today on Buy, Hold, Sell. We'll catch you next time. Take care.
Cheers.
Buy, Hold, Sell, brought to you by CrossCheck Management.
If you like Buy, Hold, Sell Live, be sure to smash the like button.